let's get started then, Claire. We can go on to the next slide. So thank you for having me, Claire, here. I've been here before, so clearly I did just about enough, Claire, not to disappoint you that I've been invited again, which is an achievement for me usually, because I think talking about tax ends up boring most people, generally speaking. But I'm pleased to be here, and I'm pleased we've got a good crowd. And I'm also really pleased that obviously we've had Joy before me, because not only is she an experienced property investor, she knows a lot about tax and obviously inheritance tax. So hopefully she'll be able to contribute in my presentation too. So this is a very brief synopsis in terms of who I am. So you can just kind of click through the bullet points if you like, Claire. I'll quickly run through this. I'm a chartered accountant by profession. I've been for the last 22 odd years, been running my own practice for about 20 years, specialized in property tax. So about 80% of our clients, 80% plus in fact, are property investors using different property strategies. I'm also a property investor myself, so I own a buy-to-let portfolio. I also do commercial conversions. And just right now, I'm doing a new build project in Boston, Lincolnshire, which is building 49 new homes. Won a number of awards along the years. I'm a keynote speaker, so most of my speaking is done through Progressive, but I do speak at other events too, as and when invited. I've written a book on tax alongside some of the books on business. And I also run a few of the businesses alongside having my accountancy practice and my property business. The main business is a children's day nursery, which we're scaling up, and we're buying quite a few within the Lincolnshire and Cambridgeshire area, because that's where I'm based. So that's a brief synopsis of who I am and what I do. So if we go to the next slide, please, Claire. I'm going to try and keep this really simple, because generally speaking, when accountants start talking about numbers, we end up losing everybody in the room. And of course, it's easier to talk about numbers when you're physically in a room. Doing it over Zoom, Teams, or any other online system is slightly complicated. And my objective is to kind of keep you with me as we go through this particular presentation. So if you've got a property investor who is making £75,000 profit, if they were running the business in their own name, they would pay just over £22,000 in tax. If they were a partnership, they'd pay just under £16,000. And if they were incorporated, they'd pay £14,250, because if you're incorporated, that basically means you have a limited company, although you could have an LLP. But in this particular case, I'm referring to a limited company. At the moment, you'd pay 19% corporation tax. And of course, here I'm assuming that the person who actually owns this business isn't taking any money personally. And I'll come back on to that later. Now, this £75,000 profit is after paying all the costs. Now, let's assume that the person who owns this particular business pays £25,000 in terms of finance costs or mortgage interest costs. And if they're a sole trader or a partnership, in fact, but we'll just focus on the sole trader, because they are in the higher rate of tax, and if they cannot claim their interest costs. So if their interest costs are 25,000, that means they've made profit of 75,000, because you'd add back the interest costs. Now, on that £25,000, they would pay 40% tax, which would be £10,000. However, you get 20% relief if you go into a higher rate tax bracket. So from 50,000, from 10,000, 5,000 would be payable to HMRC, and 5,000 you would get tax relief. So if you add the 5,000 to the £22,763, you're paying just over £27,000 tax. So in that particular scenario, you would possibly think about incorporating your property portfolio, because paying 27,000 versus paying 14,250 is a huge difference. In fact, even if Section 24 weren't an issue, if you're a sole trader, you're probably still better off incorporating, depending on how much income you need to take out personally. So if we go to the next slide, please, Claire. And by the way, Claire, if anybody has any questions, I'm happy to take them as we go along. And because to some extent, I've done property incorporation to death since about 2016, I want to kind of keep it succinct and kind of straightforward and simple. So I'm not going to go through all the different pros and cons, But if anybody has any questions or you've not come across incorporation before, feel free to ask questions and I'll happily answer them. But generally speaking, the benefits of incorporating, one is you get full 100% relief on your interest costs and your finance costs. Number two, you may not have to pay capital gains tax if you can demonstrate you have a business. Now, generally speaking, this is based on the Elizabeth Moyne Ramsey case, where she had a portfolio of properties and she was spending 20 hours plus in her business. So if you're doing that, loosely speaking, you can demonstrate you have a business. Therefore, you claim Section 162 incorporation relief, which means you don't pay capital gains tax when you move your property portfolio from your own name into a limited company. If you have but you still have to pay stamp duty land tax. If you have an established partnership and the partnership then subsequently incorporates, then you could escape paying stamp duty land tax. So let's say there's 2 or more people who own property and have done for the last, let's say, 4 years as a partnership. If they incorporate, as long as they can demonstrate they have a business, they wouldn't pay capital gains tax and they wouldn't pay stamp duty land tax, which is kind of a big deal.
Does that apply to married couples?
That's fine, but they need to demonstrate they have a partnership. So if you are a married couple and you own property together, then you own property jointly. That is not a partnership. That's just property owned jointly. And that I'll link that back, Claire, to something that you asked about earlier, which is kind of the difference between joint tenants and tenants in common. So if 2 people buy property, and this is more Joy's area than mine, so Joy, feel free to jump in as and when you please. If 2 people buy property together, they own property jointly, which means that they usually own the property 50% each. If one of them passes away, the property then automatically goes to the other person. Whereas if you have tenants in common, you can split the ownership in terms of percentages. So if one person contributes 80% of the capital, for example, they can own 80% of the property, the other person will then own 20%, but it also gives you the ability then to pass your share of the property to somebody else. So let's say 2 people end up living together or they get married, but they both have children from different relationships and they want to pass over their assets to their children from their previous relationship. They can do that if they are tenants in common. But generally speaking, to answer your question, if husband and wife own property together, it's jointly owned, you would then have to go down the route of seeing somebody like Joy and create a deed of trust or a declaration of trust and change the beneficial ownership to a different ratio and a percentage. But if you form a partnership and start filing partnership tax returns and have a partnership agreement, then husband and wife would be treated as a partnership. So that would work too. And I hope that answers the question. The base cost increase is the kind of the really big one. And I hope you'll be able to focus on this with me for the next 60 to 90 seconds. So let's say husband and wife, using the previous question, have bought property, and let's say that they've bought 10 properties over the past 10 years and they've paid £100,000 each. So today they've got 10 properties which are worth £1 million. 100 grand times 10 gives you £1 million. But over those 10 years, let's say each property has doubled in value. So the value of those properties is 2 million today, but husband and wife paid £1 million for them. If you sell those properties, you'd have to pay capital gains tax on the £1 million increase. However, if you incorporate and you move the properties into a limited company, the new base cost for the limited company would be £2 million, which is the current market value of those properties. What that means is once those properties have moved into a limited company, and let's say 6 months later, you want to sell one of those properties, and that property at that time is worth £220,000. When the property was introduced into the limited company, it was introduced at 200,000 each. You've sold, and the company sold the property for £220,000. So the company would only pay corporation tax on the £20,000 uplift. And I think that is a significant and one of the big benefits of incorporating your property portfolio, because what you've done in a roundabout way is you've sheltered paying tax on the increase in the value of the properties from the time you bought them up to the date that you incorporated.
Have they got to be held in a limited company for a set amount of time, or can you move it over and sell straight away?
You can move it over and sell straight away. There's no issue with that. The one kind of setback is obviously if you own the property in your own name and you pay capital gains tax, you've then got those funds in your bank account and you can do what you like with them. You can go on holiday, you can pay for your mortgage, you can spend the money personally, pay for your personal debt. But of course, once the properties are moved into a limited company and then you sell them, the money is still stuck in the company. So if you wanted to draw down on those funds personally, you then pay income tax depending on how much money you take out. So that's one small setback, but I think the overall benefit in sheltering the increase in the value of the properties is significant.
But Shaz, sorry, quickly. If I own them personally on my own now, and I bought a property at £100,000, and now want to move it into a limited company, it's worth 150, say, do I then have to pay capital gains tax and stamp duty on that change of fee, or because I own the company?
You mean when you move the property from your own name into a limited company?
Yes.
Yeah. So if you only own one property, then you'd have to pay capital gains tax and you would pay stamp duty, land tax. If you owned a number of properties, and people usually say, how many do you mean by a number? At least 5, if not more. The more, the merrier, but at least 5 would be possibly enough, especially if you have an HMO in there as well, to demonstrate you spend 20 hours a week looking after that property business. But if you own one single property, then you'd have to pay capital gains tax and stamp duty, land tax.
Okay, thank you.
Now, once you've incorporated, as I've said in the previous slide, you'd pay corporation tax on the profits, which is at 19%, as opposed to obviously paying income tax, which could be 20%, 40%, or 45%. And of course, when you sell your property, capital gains tax rates are higher personally, as opposed to when you sell the property through a limited company, because a limited company doesn't pay capital gains tax per se, it pays corporation tax rates on any capital gain that the company's made. So again, there's some efficiency there. You can draw down on a salary, and if you're taking that £12,570 without any other income from elsewhere, that isn't taxable. You can then take out a £2,000 dividend, which again is tax-free, and there onwards, obviously, draw, which may be more tax efficient depending on your overall income. And then a big kind of plus point for people is when they incorporate, they've got limited liability. And the final one, which possibly Joyce in her presentation, is you can then look at Iht Planning by possibly setting up a trust and then moving the shares of the limited company into a trust and then having beneficiaries. The things that you need to watch out for or be aware of when doing this calculation is you'll have legal fees to pay for moving the property business into a limited company, and obviously legal fees when you remortgage. You'll have to pay valuation fees. You may have to pay a higher rate of interest depending on what kind of a rate you can agree. But generally speaking, interest rates are higher when you're financing through a limited company as opposed to your own name. They are become more competitive, and they have done over the last 4 or 5 years, but still they are higher. You have to pay arrangement fees. You may have to pay stamp duty, land tax if you don't have a partnership. You lose an annual exemption. So every single year, every single person gets an annual exemption for capital gains tax purposes. A company isn't an individual, therefore it doesn't have an annual exemption. And the last point there is, if you have a limited company, you'll have to pay tax twice, or possibly pay tax twice. Once when the company reports its profit and you pay corporation tax. The second time when you draw down on those funds personally by way of a salary. Next slide, please, Claire. Now, the key things that you ought to be thinking about, and kind of feel free to take a photo of this slide, is when you're thinking about which structure works best for you, these are the things that you should be thinking about and how they affect you, from the number of people involved to how much flexibility you have in terms of managing a business. So again, generally speaking, if you own property in your own name, if you have a partnership, those structures are more flexible as opposed to having an LLP or a limited company, because you've got the Companies Act and you have to follow the rules and the compliance rules per the Companies Act, which makes it more onerous and less flexible. You then got to give your admin costs in terms of running that particular structure, your tax costs, commercial considerations. Privacy there basically is if you have a limited company on an LLP, your information is to some extent publicly available on Companies House. If you're a sole trader or a partnership, nobody knows what you're doing apart from you, your partners, your accountant, and HMRC. And then you've got other things like national minimum wage, share options, exit strategy. So these are some of the things you ought to be thinking about and how they apply to you before you think about which structure is best for you. Next slide, please, Claire. So here, Claire wanted me to kind of cover LLPs briefly. So with an LLP, you have two or more entities who come together to form a business. So these can be two individuals, husband and wife, business partners, friends, mother and daughter, so on and so forth. Or what you can have is, it can be you as an individual, and then you can set up a limited company, and your limited company can be a partner in your LLP. They'll be classed as a corporate partner. And in that case, you'd have what's called a mixed partnership. So you don't have to have a second individual per se. You can have you and a limited company, and both of you be members of a limited company. And members who have, a limited liability partnership. Every member who's part of an LLP has limited liability, the same thing as a limited company. It's treated as a separate legal entity for all intents and purposes. Unlike a standard partnership, so if you're a standard partnership, generally speaking, you are jointly and severally liable for the debts. So if one partner doesn't pay the debts, the other partners are liable for those debts. In an LLP, that doesn't apply. The only time you would be liable for a debt is if you're found to be negligent in running the business, where you've made a particular choice or a particular decision that you shouldn't have done because it wasn't for the benefit of the company, it was for your personal benefit. However, if you work with a pretty smart lawyer, someone like, for example, Joy, if she's still on the call, you can have documents and agreements crafted and created and designed in such a way which demonstrate that you're signing contracts only on behalf of the LLP and that you don't carry any personal liability for those. Now, that needs to be done carefully and sensibly. And obviously, when you're entering agreements with third parties, you need to obviously make sure that they sign those agreements. That can get you off the hook, basically. Next slide, please, Claire. Now, unlike a limited company, if you have an LLP is transparent for tax purposes. What that means is that an LLP does not pay tax. The individual members pay tax. So on the screen right now here, I can see Chris Holt. So if Chris and I went into partnership and we formed an LLP and we've made £50,000 profit, and we both are 50% partners, Chris would pay tax on his 25% of the share based on his overall income for that particular tax year. I'd pay tax on my 50% of the share based on my income for that tax year. If we were a limited company, the company would only ever pay corporation tax. LLPs work differently. Individual partners pay tax based on their overall income.
So if both individuals in the LLP, right, had individual limited companies, right?
Sorry, I missed the first bit there.
Right. So yes, you had two people in the LLP, right?
Yep.
But each person in the LLP was actually a limited company, right?
Yep.
So the person sat behind the limited company entity, yeah?
Yep.
And then was in the LLP, right? The
Yep.
tax, the money would be taxed at the corporation tax of 19%, right?
Yep.
Rather than 40% potentially if it was a higher rate taxpayer.
Yeah, that's right. Yep.
Yeah. So you would do it that way, wouldn't you? Rather than rather than being an individual member then?
Well, there are certain rules, because what happened back in 2013-14, what people were doing was they were entering into partnerships through an LLP, but the partners were limited companies. They were then drawing down the funds to the limited company. And back in those days, if anybody on this particular presentation was around running a business, you had your tax-free dividends. So unlike now, you pay 7.5% tax on your basic rate of income. In those days, there was no tax to pay if you drew down on the dividend. Was forming limited companies. Limited companies become partners of an LLP. They were then paying 19% corporation tax, taking the rest of the funds into the limited companies, then drawing down on dividends and not paying any tax whatsoever. So HMRC, or the government, brought in anti-abuse measures to stop that happening. So you can do that, but you have to do it carefully and sensibly, and it can't be just for the benefit of you paying less tax. And the last bit there for you in terms of an LLP is you need to be thinking about how you can make best use of capital allowances, pension payments, cars. So for example, if you have a limited company and the company owns a car, which you use personally, you'll have to pay company car tax. If you have an LLP and you use a car personally, there's no personal tax to pay, or there's no company tax to pay because you're paying tax personally. So what would happen is you would only claim some of the expenditure. So let's say you've got a car owned through an LLP and you've worked out in a year, you drive 10,000 miles, or you've driven 10,000 miles, and you've established from those 10,000 miles, 3,000 miles worth, 7,000 miles worth for business purposes, and the cost of running that car in the year was, let's say, £10,000 to keep the numbers easy. Because you've driven 30% of the car personally, and it's cost you £10,000 in the year to run it, you would only claim £7,000 to the LLP. The other £3,000 of the cost, which is 30%, you wouldn't pay. You wouldn't claim that as an expense through the LLP. Now, generally speaking, that's going to be more efficient than running a car through a limited company, unless it's a fully electric car, because you'll be charged tax based on the CO2 emissions and the value of the car. So an LLP or a partnership or a sole trader are better mechanisms for company cars. In terms of capital allowances, especially if you're doing service accommodation, you could have a scenario where you're claiming capital allowances and reducing your profit in your LLP to virtually zero. So let me give you an example. Let's say Claire buys, and let's say Claire is already running a service accommodation business. She buys a new commercial property and claims capital allowances on the property when she purchases it. She then spends, let's say, £100,000 on fixtures, fitting and equipment, which all qualify for capital allowances. If Claire makes £100,000 profit in that particular year, she can write off that £100,000 that she spent on the capital allowances in one go and therefore pay no tax to the LLP. What that means basically is the LLP has £100,000 sat in the bank account. Claire's made £100,000 profit, written it off against the capital allowances, so she can draw down on the £100,000 through the LLP and pay no personal tax whatsoever. And that's a really powerful mechanism in terms of using LLPs with capital allowances, especially if you're running service accommodation. Now, Claire hasn't used up all her capital allowances, because if you recall from the example, she used up the £100,000 when she refurbished the property to get it ready for service accommodation, but she also claimed capital allowances on the purchase of the commercial property. Now, she won't use those capital allowances in that particular year. She can do and create a taxable loss, or she can carry those capital allowances through to next year and claim in the following year. So capital allowances work really well. Same example for a limited company, £100,000 profit, £100,000 capital allowances, so the company pays no corporation tax. However, if Claire wants to draw down that £100,000 sat in the limited company for personal purposes, she'll have to pay income tax. And that's the difference here. No income tax to pay to the LLP because you've used up all the profit against the allowances. limited company, you get the same allowances, but if you use the money personally, you've got to pay income tax. Next slide, please, Claire. So I guess the point really is when you're looking at your structure or you're looking at going into a different property strategy, always make sure you explore how you could possibly use an LLP. It doesn't work in all situations and circumstances, but it's worth you exploring the numbers to see if it's going to work for you. Limited company, again, the clues in the name. You've got limited liability, ring fence to the company. Generally speaking, you're paying a lower rate of tax compared to personal tax, because we've already established that's 20%, 40%, or 45%, depending on which bracket you're in, where a limited company at the moment only pays 19% tax. Another big benefit from my point of view is you can spread kind of shares in different classes. So let's say you've got a husband and wife situation and they've got some children and they want to give them shares. They can give them alphabet shares, so A class shares, B class shares, so on and so forth. And they can limit how much influence and control their children have. So you can limit their voting rights, rights to capital, and rights to distribution on winding up. So that works well. The other side of it, of course, is you can have growth shares and freezer shares. So you give some of your shares to your children, you can give them alphabet shares, and say from this day onward, we're going to freeze the value of our existing shareholding, but all future growth of the company, that growth goes to a different class of share. And what that means for inheritance tax purposes is you limit your exposure to inheritance tax based on the value of the shares on the day you freeze them. All future growth over the next 5, 10, 15, 20 years plus will go to your children. And that on that growth, there's no inheritance tax payable by the parents. So I think that's a good mechanism to use for limited companies. The next one is you ring fence the liability to one single company. So let's say somebody's doing commercial conversions and they're doing 2 or 3 commercial conversions. To put them all into one company would be a bad idea, because if one project goes badly wrong, that means you jeopardize all the other projects. Whereas if you've got 3 separate companies and one goes badly wrong, then you can kind of liquidate that. But the other 2 are going to be safe because you've ring fenced the risk. So that is useful when you have limited companies. When you have all of the projects in your own name or a standard partnership, there's no ring fencing per se. And the last one there, of course, is you can manage how much income you take out personally, because you would try and take out the least amount possible to try and remain as tax efficient as possible. Whereas with a sole trader partnership on LLP, you determine how much money you take out, because on all those 3, you pay tax based on the profit. Whereas with a limited company, you pay tax based on the profit, but you only pay income tax when you draw down the funds. So in one particular year, if you made £100,000 profit after tax, if you don't need any income personally, you don't draw down on that income. So those funds stay in a limited company. So therefore, you don't pay any income tax. So that's a good benefit of having a limited company, in the sense that you can control how much income you take out personally in line with the different tax rates and allowances. Next slide, please, Claire. Another benefit which you ought to be thinking about is there are certain tax reliefs which only apply to limited companies. Now, the first one is R&D, and this would only apply to you, generally speaking, if you're in the world of construction. So you have a construction company where you're building houses or flats or property, you may be able to claim R&D relief. The next one is LRR, land remediation relief. This is to do with a property that you buy which has contamination, Japanese knotweed, asbestos, etc., and you pay to have that removed. You can claim LRR. IR is investors relief, where you have investors who invest in your company. If you have a trading company, they can claim investors relief and they pay lower rate of tax. SSE stands for substantial shareholding exemption, and I'll try and cover that for you when I look at the holding company structure shortly. So Claire, when I get to the slide on the holding company, just remind me SSE or say substantial shareholding exemption, and I'll cover that. Another benefit of having a limited company, you can have share options and you can have incentives for employees to kind of get them to stay with you for longer, whether it's giving them alphabet shares or whether it's giving them an enterprise management investment scheme or other types of incentives to lock them in as employees. What you ought to be aware of course, is if you have a limited company, your compliance costs are going to be higher because you've got to file limited company accounts. You've then got to make certain disclosures on those accounts. And then because the company is a separate legal entity, you have to file a corporation tax return, which means your accountant, generally speaking, will charge you more for limited company accounts than they would do if you own the property in your own name. The next point I would have covered for you, which is your interest rate is going to be higher through a limited company as opposed to buying property in your own name. If you want to draw down a salary, you have to be PAYE registered through a limited company. If you're drawing down income through an unincorporated body like a sole trader or partnership, there's no PAYE because you are the business, so you don't have to register for PAYE, and any money you draw down is treated as drawings. So again, just bear in mind you'll have additional obligations and costs for running a PAYE scheme. And then the last one, which I've already covered for you, is double taxation. The company will pay corporation tax. You then pay income tax based on any income you draw down. Next slide, Claire, but I'm happy to kind of stop there for a minute if anybody has any questions. Sorry, previous slide, Claire. In that case, I'll carry on and I'll answer questions at the end. So here, again, keeping it very kind of highbrow and simple is, at the top here, you've got HCO. HCO, simply speaking, is your holding company. The 4 boxes below that would be your separate limited companies. Generally speaking, we call them SPVs, special purpose vehicles, and you would own property in those companies. And one kind of obvious benefit is in box 1, let's call it SPV 1, you could own 50%, and one of your joint venture partners or another investor could own 50%. In box 2, you can have a different investor and a different JV partner, so on and so forth. If you're doing commercial conversions or new builds, as I am, you would keep every single project in a different company. So if you're doing 3 or 4 developments, you'd keep them in 3 or 4 different companies. Coming on to the substantial shareholding exemption, which I asked you to remind me of, Claire, is basically, let's say I'm building houses, and in company 1, I've built all the houses, and somebody comes along and says, I'll buy the entire company from you. I can sell that company to them. I sell the shares of that company to them, and the money from the sale of those shares would go up into HCO, because HCO is the ultimate owner of that company, and HCO wouldn't pay any tax on the disposal of those shares as long as HCO has owned those shares for 1 year and owns at least 10% of the share capital. That's a huge benefit. Now, if I own that company directly, personally, if I sold those shares to a third person, I'd have to pay capital gains tax on the value of those shares. But if a holding company sells those shares, owns them for a year, and owns at least 10%, no tax to pay. That's a huge benefit if you're selling a whole portfolio to a third party in one go. Now, if you're building 49 houses like I'm in Boston, it might not be as easy to sell all those to one particular buyer. But if you think about it, if you're selling 2 or 3 or 4 or 5 houses, it's usually easier to sell those portfolios compared to bigger portfolios, unless you've got institutional investors who want to buy the whole lot. Benefit of having trading limited company, because you get that additional tax relief. But so, and if, for example, you've box 1, you've sold off all the properties, you can then move the funds from that company into the holding company as a tax-free dividend, and then move those funds down to box 2, 3, 4, so on and so forth. So in terms of moving money from one company to another, it's very tax efficient because there's no tax to pay. You ring fence your liability. If you sell the shares, you may not have to pay tax if all the money goes into on HCO. So there are quite a few benefits of having a holding company structure. It gives you flexibility of having different partners and different associates and different investors. Yeah, and on top of HCO, you'd have the people who are the shareholders ultimately of the holding company. Now, generally speaking, people ask, does a holding company trade? A holding company doesn't trade. The only thing the holding company does is own shares in all of your investments.
Can a holding company, right? I've just said
Sorry?
right? Can a holding company, right, have been a previously trading company which has money in it, or would I need to shut it down?
Yes.
To pay tax.
It can be, as long as you know there won't be any comebacks for any work that you've done. See, in this particular structure, the way that I've shared it,
Yeah.
if it's a box one, which is SPV1, and I should have labeled
Yeah,
these
so
boxes.
I'll tell you where I am, Shaz. Yeah, I've run a tree company, right? But I've got money in it, right?
Yeah,
If I close it, I'll pay tax on it, right?
yeah,
If I just simply stop trading, right, but then use that money that's in that company, yeah, and change the number on that company. What do you call it? The unique number, the SIC code
yeah.
number, yeah.
Standard
I wouldn't then pay any tax on that company being shut down.
No,
Yeah? But I
no.
have that money still sitting in there. The
Yeah,
£80,000
that's
sitting
fine.
in there
That's
now, I wouldn't
fine.
pay tax on it. But I would have
Yeah,
pulled it
that's
out.
fine. But no, you can do that. But the challenge you've got, my friend, is the holding company isn't supposed to trade. So let me kind of answer that question in a roundabout way. So box one here, if something goes wrong and that company has to be liquidated or shut down, box 2, 3, and 4 here are going to be safe. Yeah. However, if HCO is trading or has done business transactions, and let's say somebody wants to sue HCO, if HCO goes down or is liquidated, the 4 boxes beneath it are all jeopardized, and whoever you owe money to can stake a claim against those companies. So coming back to your question, my friend, is as long as this company that you're talking about, which you use for your tree business, nobody wants to sue that in the future, you're okay. But if you've got a customer, for example, who you've done some work for, and a tree falls down or something happened to or the roots kind of destroy a house, and that person blames you for it, okay, and you're responsible. If you use that as your holding company, then any companies you've got beneath it will be jeopardized. So as long as you're kind of comfortable, there aren't any claims against that company in the future, by all means, use it as a holding company.
And Shaz,
okay? Chris?
I've got one, Shaz. So in that scenario you used before, where you've built this portfolio and somebody's purchasing it from you, that SPV1, from their perspective, do they pay, what stamp duty do they pay? Do they get away with it?
So they would pay stamp duty at 0.5%.
0.5%, yeah.
So
Nice.
just to be clear, Chris,
Yeah.
if you've been buying and holding on to property,
Yeah.
The example that I've shared in terms of claiming substantial shareholding exemption isn't going to work. This only works if you're building new properties and you're a property trader, which means you're selling property. Yeah.
Yeah. Okay.
But to answer your question, whether you have a property investment company, i.e. you buy and hold property, or whether you're a property trader, i.e. you buy, develop, redevelop, and sell property, when you sell the shares in that company, whoever buys the shares only pays stamp duty at 0.5%, as opposed to paying the higher rate when they buy personally.
That's brilliant. Which one's the LLP? Where can an LLP sort of squeeze into here somewhere as well, into this structure? Or
you can squeeze an LLP into this because using the earlier slide, I said you can have an LLP where you have a limited company, which is a member alongside you being a member. Okay. So your holding company could be a member. But generally speaking, Chris, I'd say where possible, keep the LLP separate, because with the mixed partnership rules, you could quite easily fall foul of the rules, which means you may end up paying more tax, and even though you've not tried to gain an advantage from a tax point of view. So I would keep the LLP separate and have usually what people do is they have that as a management company. So when they're doing work in this particular structure for box 1, 2, 3, and 4, they charge a management fee for their services. Yeah. Now you don't have to have an LLP to charge management fees. You can have a limited company and charge management fees. You can charge management fees as an individual. But generally speaking, people tend to use a limited company or an LLP to charge management services. Now, the box on the right-hand side, by the way, says investment. This basically is also a limited company, and here you own properties that you want to hold on with a long-term objective. So that becomes your investment company. The diagram on the left-hand side is your trading holding company structure. So I've kind of run that through that very quickly, Claire, because usually I spent about an hour and a half just talking about the holding company structure. But I know you wanted me to talk about other things, so I've kind of kept it very, very brief and very, very tight.
I have a question for you, Shaz. It's Azzy here.
If you could, by the way, when you want to ask a question, if you just share your name, because I can't see everybody on screen, and this makes it easy for me.
No worries. It's Azzy. It's Azzy here.
Hi, Azzy.
So, hello. So the structure here, in terms of the holding company and the SPV, let's assume you have the holding company set up, after you set up the SPV. How do you link the two together?
Okay. So if you're starting off, then I'd say seriously think about a holding company structure and form that on day one, because that's going to be cheaper for you. If later on, let's say 2 or 3 years down the line, you want to add a holding company on top of your existing limited company, that's going to cost you quite a bit of money in terms of tax advice, and possibly, depending on who you speak to, a tax advisor or an accountant like myself may say to you, let's apply for clearance with HMRC to do a share for share exchange. Because what happens is you'll have to give your shares away to this new holding company. In exchange, the holding company gives shares to you in that company, if that makes sense. So you no longer own the shares in the current limited company that you own. You give those shares away to a holding company. The holding company gives you its shares. That's called a share for share exchange. That has income tax, corporation tax, and possibly stamp duty, land tax implications. And you need to have a tax advisor who specializes in property to give you the advice to share with you that there's no tax consequence for you. Or you can apply to HMRC to seek clearance just to make sure you have to pay no tax. So I'd say to you is, if you have an existing company, as long as that doesn't own any property, treat that as your holding company, just like our friend asked earlier who owned the tree company. But if you have a company that owns property right now and it's an investment company, then treat that as the company on the right hand side, and you don't need a holding company structure for your investment business per se, unless you've got different JV partners. And I'd say form a new holding company now and then form SPVs beneath it, which are called subsidiary companies. Does that help?
It helps, but I think probably I need to have
complicated, I wish I had a flip chart and I can kind of talk you through it. It would make more sense. So it's harder to kind of get that over to you. But the basic essence is, if you don't have a holding company structure and you have no companies, possibly start with the holding company now, because it's going to be more efficient and cheaper for you in the long run, as long as you're going to have more than one limited company. If you have an existing limited company, then think about whether you want to use that as your holding company and form companies beneath it, or think about whether having a holding company on top benefits you. If having a holding company on top benefits you, there are costs involved, and I'm talking quite a few £1,000s. It's not a cheap thing to do.
Yeah.
Shaz, it's Bryn.
Thank you.
Just as a guide, because there'll be some newbies here, and I mean, as opposed to the old wrinkly ones like me that have heard a lot of this before.
You look like a nice fresh newbie to me, by the way.
Bless you. 30 years of doing this. I'm an old wrinkly.
You hide it well.
Obviously, there's some newbies here. Now, one of the problems that we've always found with newbies is that they're most concerned about cost. And you can set up a limited company for 25 quid, which is a complete mess up, screw up. The M&As are wrong, and it causes massive problems in the future that we generally have to charge about £10,000 to resolve. Because they spent 25 quid up front doing it themselves.
Yes.
For a newbie to set up a holding company with 2 other structures underneath, because one's to do deals with and one's to do flips with or whatever, roughly how much should they be spending to get this structure right from day one? Roughly.
Okay. So, and you make a really good point there. So, and it's tempting for people to pay £25, and then they soon find out, let's say 2 years down the line, that the articles of association don't really meet their objectives, and then it costs them, let's say, £2,000 to £3,000 to then change those articles of association to meet their objectives. So you're better off doing that up front, and a kind of a half decent accountant who knows a bit about company law will charge you, say, between £300 to £500 per company to set it up for you. So if you're setting up 3 companies, it'll be anywhere from, say, £900 to £1,500, but you'll have bespoke articles of association in line with what you're looking to achieve. And generally speaking, and I think people on this call will say, you're bound to say this, but generally speaking, I think that's money well spent.
I totally agree. But it's hard to get that across to, I can do it for 25 quid. Yes, you can. And it'll cost you 6,000, 7,000, 8,000 quid later to
You're absolutely right.
Get over the screw up. In between how much tax you've now cost yourself in the meantime as well. But to be able to quote a relatively, understandable figure, if somebody's buying property, then they should have deposits lying around. So £1,000 to 1,500 quid is money very, 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 very well spent.
Absolutely, yeah, and you're right. And if they don't do it right at the start, then I've seen people spend 2, 5, 10, even £15,000 on changing things around, because once it's set, then there are additional implications, both from a tax point of view, from a legal point of view, from a company law point of view, from a VAT point of view, and to fix all those moving parts, it costs a lot of money.
Yeah, 100%. Because the longer you keep going in a wrong strategy, the worse the problems get, and the more it's going to cost us to solve them. Totally with you. So that's really handy. So for anybody sort of new or newish or thinking about this, 100%. Between 900 and 1,500 could get you a proper structure with articles that are right, fit for purpose. You've got a structure that you can grow on. I assume then adding another SPV once the structure's right is relatively less expensive because the initial structure is already in place.
Absolutely, and if the aims and objectives of that additional company are going to be similar to the previous ones, then to some extent, obviously, you can use the same articles again. And
it would just be a copy, wouldn't it? It would be another SPV with a different JV. Is generally how this would go. So that company 3, you'd think would be slightly less expensive to set up because they're coming back to you who started it in the first place. You know what's going on. You know their strategy.
That's right.
Brilliant. Well, that's incredible value. Thank you.
You sound like a good hybrid between an accountant and a lawyer, by the way.
Oh, that's because I'm the pensions guy.
Even better than,
So, Shaz, I've got a question. So I've heard that some people will buy, so for instance, a buy-to-let in a limited company, and then they will buy the next one in different limited companies, so that when they sell it, they can give the shares to like their kids, and therefore instead of having to sell off all of it because it's all in a limited company, they've got the option then of doing it individually. Is that what some people do? Does that make sense?
Yeah, I can't see the benefit of that. So from time to time, Claire, once every, say, 3 or 4 months, I have somebody ringing me up who says I own, say, anywhere between 2 to 5 properties, and they've got 2 to 5 separate limited. I'm yet to see what the benefit of that is. The only time you would do that, Claire, is if you own, let's say, 5 companies in 5 separate limited companies, because you've got 5 separate business partners. That then makes sense. But if it's the same people or the same persons owning the same properties, then in the same ratio, then I can't see the purpose of having more than one limited company.
Okay, thanks.
As does your practice or your company manage different industry companies as well as, or just property related stuff?
Oh, so like I said at the start in the introduction, historically, we started off looking after general businesses. So 80% of our clients are property investors, but some of those have other businesses, whether they're doctors, dentists, shops, retailers, restaurateurs, so on and so forth. And the other 20% aren't interested in property, so they own other general businesses. So it's a mixed bag, but the main emphasis is obviously on property.
Yeah. So I'm going to have a chat. Yeah.
Anytime,
because Shaz does my asset leasing business, so he helps me with that, and then he's going to help me with my property as well. So yeah,
of course, I'm delighted. So
that's
two more slides, Claire, if I can quickly run through those. So here's kind of some of the benefits which I've already kind of quickly covered for you. Is you can split trading and investment. So if you take nothing away from this particular call, please take away the fact that if you set up a holding company structure, first of all, don't form 3 or 4 companies beneath it unless you need them. So only form a limited company or a subsidiary when you need it. And whatever you do, if you're going to have a group structure, either have it as a group structure for investment properties only or trading activities only. Don't mix the two, because when you mix the two, let's say, for example, you've got you buy, refurb, and flip on properties, and you also hold properties. If you mix them together and have a mixed group structure, so you've got investment properties you hold on to and some you flip on or you sell. If 20% of the income, so the turnover, the profit, the value of the assets, or the time spent is linked to the investment business, you then lose your trading status. Now, if you go back to one of the earlier slides, which don't have to go back to Claire, by the way, but if you cast your mind back to one of the earlier slides, I mentioned entrepreneurs relief, investors relief, R&D relief, land remediation relief, substantial shareholding exemption relief. Those are only available to trading businesses. If you have a mixed structure and you breach the 20% rule, you lose trading status. That means at some point in the future, you may have to pay a significant amount of tax, and you want to avoid that. Now, of course, if you fall in the trap where you have a mixed group structure, i.e. trading and investment, we can do something called a demerger and split them off. But again, like our pension friend was talking about, that's going to cost you a lot of money to do a demerger. I mean, the starting rate, just so you know, for a demerger, you're looking at £10,000 plus, depending on how complicated the work is. It's not cheap, it's expensive. So do not mix trading and investment. And again, if you cast your mind back to an earlier slide where I had the group structure, I said keep investment separate. The reason for that was so that you do not have a mixed structure.
On that point, Shaz, I've got a client he started off his first SPV for holding limited. He bought 2 properties into it, and he then went on and took some rent-to-rents on into it, and lease options into it. So he mixed the 2, and then it got him in trouble with the mortgage company, then he ended up having to set up a separate SPV, which he's learned his lesson now. But he's ending up with two separate SPVs. Can he somehow, will that good SPV be able to buy from the old SPV and only pay the lesser stamp, or? Yes.
Okay. But no, because if the new SPV or the new limited company buys the shares in the existing limited company, then they become linked, so you're back to square one. What it can do, it can buy the asset. If it buys the asset, it's going to have to pay the standard rates of stamp duty, land tax. So that's not a good idea either.
Okay.
Yeah.
Thank you.
And then if one limited company is selling assets to another limited company in the group structure, as long as the holding company owns 75% of the group, there's no capital gains tax, any income tax or stamp duty, land tax to pay to move properties over, just so you know. So that's quite beneficial as well. And point 6, which is do not have your buy-to-let mortgages in the group trading structure. One last slide, I think, Claire, and then I'm happy.
Sarah, you got your hand up, love.
Hi, Shaz. I just wanted to ask a quick question because Bryn likes to introduce me as the Virgin Property Developer. I bought a property in a limited company. Is there any way I can because I got a bit confused at the beginning because I am the virgin property developer. Is there any way that I can claim the stamp duty back in the limited company?
No, because when the company bought your first property, the company would have paid stamp duty, land tax.
Yeah.
So you can't claim that back per se.
Okay. So no question's a stupid question. It's just that I thought I'd ask it.
Yeah, something that, I mean, we do a lot of work on stamp duty, land tax. Something that may apply to some people here is if you buy a property, as in a residential property, which isn't fit for habitation. So let's say the roof's missing, or let's say the plumbing system is in a very bad condition and kind of some of the pipes are sticking out, or the electrics are in a very bad condition, so you can't occupy that property, then you may be able to claim some stamp duty, land tax back. That may apply to you. Another kind of common one which you ought to be thinking about is if you're buying a property and it has a granny annex at the back on the side, there may be an opportunity if you bought it already in the last 12 months for you to claim back stamp duty, land tax. There are quite there's quite a few different connotations for SDLT, but those two are the kind of common ones. So if you bought a property in the last 12 months and it was in a very bad condition, you may be able to claim stamp duty, land tax back. And if you bought a property with a granny annex, there's an opportunity there. And there's many other kind of exemptions, but I'm not going to cover those today, but I'm happy to come some of the time, Claire, just to talk about SDLT. Here's a quick slide for you.
Sorry to interrupt, Mikey here. Is there ever an occasion? Obviously, I'm in SA and we are looking to buy our first SA. Obviously, we would pay a stamp duty there. However, it wouldn't be classed as a residential property. So therefore, would we be able to claim some sort of a relief back on that based on the stamp duty that we pay?
Okay, so if you're buying a commercial property, Mikey, then the stamp duty, land tax rates are different.
Okay.
And generally speaking, will be lower overall than buying a residential property. And of course, if you're buying commercial property, then you don't pay the additional 3% stamp duty, land tax if you already own a property.
Okay, so if it's not necessarily, if it is a house and it stays a house, but it's going to be traded as a serviced accommodation,
that's not going to work. No,
you're not going to work. Cool.
Yeah.
C1.
That's right. So here's
sorry, Jazz. Can I just build on? If there is a serviced accommodation property running as serviced accommodation today, and then you buy it, then it's commercial property. So it's treated as commercial stamp duty at that point.
No, as long as if you change the class use for it to be classified as a commercial property, then yes. But if
we're paying business rates, so yeah. So it's paying business rates.
No. Paying business rates on a property doesn't make it commercial per se. What you pay business rates because there's a commercial activity taking place on the premises. Yeah. So that in itself isn't going to make it a commercial property.
Right. Okay.
Yeah.
All right. Okay.
Because you pay business rate to your local authority, and you may be running a business from there. Therefore, say, okay, pay us business rates, because obviously business rates, again, generally speaking, are higher than council tax. So obviously, the local authority would rather charge people business rates because there's a business running from there, as opposed to charging you council tax.
What happens if it's a C1 though, rather than a C3? So C3 is residential, C1's holiday, SA is potentially SA, depending on where it's been started and how they've looked at it.
Yeah.
So on C3.
Well, basically, the local authority would not let me convert my stables as a C3. It was a C1, and it has planning conditions on it, which basically stipulate it has to be run as a holiday let. It has to have commercial books associated with it, and they have a right to ask for information to confirm that it's actually been run as an SA unit. service accommodation unit and not being used for residential purposes?
Every local council is different on that one, because my daughter just bought a bed and breakfast property, which was C1, got planning permission to convert it to a holiday let, and the local authority insisted that she had to run it it had to be converted to a C3 in order to run it as a sleep 16 holiday let, which is clearly commercial. It's clearly commercial building, but they wanted it moved over to C3. But the accountant's advice that we got at the time when she bought it, some time ago now, was that it was paying business rates. It's going to carry on paying business rates. Therefore, it's commercial building. Therefore, no problem. It goes as commercial stamp duty.
Yeah, and the accountant was right there, and you're right. Different local authorities see things differently. But using the example of your daughter there, I would have challenged that and said it should remain C1.
Yeah, should it remain C1?
Yeah.
The local authority wouldn't allow you to run holiday lets as C1.
I would have spoken to a planning consultant at that point.
Well, that was the planning authority that insisted that it moved to C3.
Yeah. So without kind of covering old ground for you, it depends. If it's a bed and breakfast, service accommodation can also qualify as a bed and breakfast if you're offering additional services, which then helps you get to some extent around that particular planning criteria, because you are offering more services than just somebody renting rooms from you. And that can, at some point in the future, assist you, and this is not guaranteed, for inheritance tax purposes. Because if you own shares in a trading business, if you then die or pass away, those shares can then go to your children or somebody else, and you get to claim something called business relief. Now, that doesn't apply if you have an investment company where you hold property, but where you have serviced accommodation and you have a high level of other services offered, i.e. a bit like a bed and breakfast or a hotel, then you may be able to claim business relief. But obviously, we can't go back and change that with your particular local authority. Now, for all intents and purposes, I'm also a city councillor, so I kind of appreciate that different councils work differently. And I hope my local authority in Peterborough here won't mind me saying that just because a council has a particular point of view, it doesn't mean they're right. Okay? So feel free to challenge them. And sometimes that may be difficult and onerous, and you may need a planning consultant involved. But don't just shy away from the fact that just because a council or even HMRC, by the way, say something is as it is, it doesn't mean they're right. That's their opinion.
When I did my conversion, it was an illegal HMO into, I turned it into 3 separate apartments as holiday lets, and the council tried to charge me council tax, even though it went back to brick and it's uninhabitable. And they charged me nearly £2,000 in council tax. And I got my planning consultant involved with it, and they relinquished all the council tax from the point that it was uninhabitable. So
yeah. So
I like Naz's comment, if you die. I mean, I hate to be the one to tell you this, mate, but that's kind of guaranteed.
Okay, let me rephrase that. When you die, yeah.
All gonna die.
Yeah. We're all going to die, I'm afraid. Yeah. So, and I'm sorry to break that bad news to you, but on that particular point, if you're ever carrying out major works to a property, be it commercial or usually commercial, or always make sure you take photos and let the council know, because they'll then come back to you later on and they'll try and charge you business rate or council tax for you.
See, this is why this group is so great, because if I'd had that advice when I started on that project, I would have known that, and I wouldn't have had to pay the council tax in the first place.
Yeah. Exactly, but we're all kind of.
I've only been inviting her for a year to join this group.
Oh, shut it, you.
And I'm sure she's very glad she's here now. But to kind of finishes that particular point, it's not just about telling the local authority. Make sure you take photos, and you have to tell the VOA that you've taken it back to brick, and then the VOA will then say, okay, no council or no particular property, and then the council won't charge you business rates. That's important. Otherwise, I can tell you from experience, it's going to cost you a lot of money to demonstrate to the VOA that you went back to brick, and then they want to know the exact date, they want to see contracts, they want to see invoices, all that kind of stuff. And once you finished up a particular project, to try and find out all the paperwork, it's not always the easiest thing to do. So here's kind of a list of some of the things I think property investors, you should be aware of. So take a photo of these things here, and just as and when they apply to you, use them. I think a really good one here is the second one from bottom, rent a room relief. So if you're looking to, let's say, run serviced accommodation, and you're new to it, and you just want to use your own house because you've got a spare bedroom, you could do that from home. And as long as you give the person or the people renting that room from you access to your kitchen and to your bathroom, you can earn up to £7,500 every single year tax free, because it's covered by rent a room relief. It doesn't have to be serviced accommodation, by the way. You can just have a lodger living in that particular property, paying you up to £7,500. But if you want to test service accommodation, that's a good way of doing it.
We tried that at ours, to be fair, Naz, but the bastard's stepson lost his job and is now here rent free.
Oh, well, there's always a downside. Don't rent it to family. Yeah. So that, Claire, is me done in terms of the slides. Happy to take as many questions as people have, if any, by the way.
No problem. There was a couple more slides, I think. I don't know. Hang on.
Were there?
I've accidentally drawn on it too.
Oh, there you go.
But that's Shaz's holiday photos.
Yeah, that too. So here's some other considerations if you have a limited company, in terms of the things you should be looking at in terms of your year-end profit, what expenses you can claim, any investments you can make, ISAs, obviously ISAs, EIS, Enterprise Investment Scheme, VCT stands for Venture Capital Trust. Those are the kind of things you should be thinking about. Pension contributions, you can pay up to £40,000 every single year, but we've got our friend here who's a pension specialist, so I'll leave him to cover that kind of information. Capital gains tax, using your annual exemption every single year, looking at your inheritance tax exposure and how you can reduce that, making gifts and donations, how much you take out as dividends. Section 24 we've already covered in terms of incorporation, and then kind of managing your income so that if you have children, you still qualify for child benefit. Because sometimes what happens is one partner or spouse ends up earning, say, £65,000, the other one earns £35,000, and they've got two children, and they end up losing child benefit. Whereas if they split the income slightly differently, and let's say both were earning £40,000 each, they could still carry on claiming child benefit. So it's a small benefit, but it still adds up. I think that might be the last slide, Claire. I think I could be wrong. Yeah.